This is Jim Lee with StratFI. People are wondering if we're at the edge of a collapse for the market. It's been almost 10 years since the 2007 financial crisis, and valuations for stocks are just slightly higher than normal. Meanwhile, there is a lot of political uncertainty going on right now. From my perspective, this is not a raging bull market. It is, however, a very reluctant bull market with more room to move on the upside. If you look at the numbers, annual returns for the S&P 500 for the past 16 years have averaged just 5% per year, which is a traditionally bond-like level of return, not exactly irrational exuberance. So if you've been watching the news, you'll be hearing that the S&P 500 and the Dow Jones Industrial Average have both been hitting new highs recently as a continuation of a trend that we started to see in mid-November. What's worth mentioning is that the recent bump in equity prices has occurred in the midst of both declining trading activity or volume and also relatively low volatility. And this to me suggests that what we're seeing is not necessarily a frothy market at all, despite the fact that the economic leading indicators seem to be reasonably supportive of a good market. We've seen declining unemployment, factory orders have been strong, consumer expectations have been unusually strong. The only real weak thing that I'm seeing here is building permits and potentially real estate, and that may be the result of slightly higher interest rates. So thinking about this and really why investors have been reluctant to embrace the markets, a lot of that may be reflected in net flows of funds since 2008. And this is really kind of interesting because we all know that mutual funds have been losing assets, and to a certain degree those assets have been absorbed by exchange-traded funds. However, when you net the two against each other, what you'll find is the yellow line here suggesting that assets have been leaving the stock market since 2008, going into potentially real estate investment trusts that are unlisted, or annuities or other insurance-related products, or being spent. So the word that you'll be hearing more of over the course of the next 2 or 3 decades is decumulation, and that is the opposite of accumulation. So when you think about it, in the 1980s and the 1990s, the baby boomers were socking money away towards retirement, putting it into mutual funds, putting it into individual stocks. Those same baby boomers are now turning 65 and 70 and starting to live off of those assets. And it also kind of explains a preference, as it were, towards more stable income-producing investments. So what you learn in CFA school is that, generally speaking, if you take greater risk, you should get greater rewards and greater returns over the long run. And this simply was not the case for the past 2 years, running from July of 2014 through July of 2016. Risk-return ratios have been kind of backwards or inverted for this 2-year period. So we have a number of different market indices listed here. The Dow Jones Industrial Average in red, the S&P 500 in blue, the MSCI EAFE, a little bit of a train wreck here in green, negative 13%. Russell mid-cap shares up 8%, and then Russell 2000 up just 4% over that 2-year period. So it was really difficult to outperform S&P 500 and Dow Jones Industrial Average by going into more growth-oriented benchmarks. But that actually changed last summer, and that we've seen a little bit more of a normalization of risk-reward relationships. So yes, the S&P 500 did well and the Dow Jones did well, but we're finally beginning to see a rebound in international stocks and grain. We've seen real significant growth in the small cap area, up 21% in the course of 6 months. That's unusual, but I'm seeing better valuations, better growth characteristics in some of those small cap companies now. So people also ask me what I think about Trump, and I tend to be politically agnostic, but my observations are that he's very comfortable with debt. That's how he built his hotel empire. As we know, he's spoken out very strongly against immigration. That's going to lead to higher wages, a higher cost of labor here in the U.S. That seems to be inflationary. If he limits trade coming into U.S. borders, that's going to lead to higher prices on imports. And if he cuts corporate taxes, it could be very good for the markets. That's going to be a type of economic stimulated, which is also inflationary. Finally, looking longer term, we've been in a period of relatively low inflation, in some cases deflation. I think people are a little bit exhausted of that right now and may welcome slightly higher prices if it comes with greater economic growth. So most of what I see coming out of this administration seems to be stimulative. However, it also seems to be generating greater risks of inflation as well. So the markets have responded to this to a certain degree by pushing down the dollar. Okay, higher inflation means you're going to have a weaker currency, and that's going to be in this black line up top here, and you can see that the US dollar index has in fact pulled back really since the very beginning of this year. Meanwhile, we're seeing a little bit more strength happening on international stocks. One of the reasons why we had such poor performance in foreign equities is because of the strong dollar. This red line here indicates the correlation coefficient between international stocks and the US dollar. It means that when you have a strong dollar, you're going to see underperformance of international stocks. When you have, conversely, a weaker dollar, you're going to see better results on international stocks. So I don't know if this is a long-term trend yet, but it certainly bears watching at this point. So thanks again for your time today. If you have any questions, feel free to send me a note, jlee@stratfi.com. Thanks again.